Good day and welcome to this short lesson on intragroup transactions relating to property, plant and equipment. In this short lesson, we're going to look at the intragroup sale of non-depreciable PPE and depreciable PPE. We're going to look at the tax implications of these transactions, and we're going to look at the effect on your non-controlling interests when you've got these two types of transactions. And lastly, we're going to look at the pro forma journal entries that must be processed in order to be able to prepare the consolidated financial statements. So let's start with an example. In this example, P Limited owns 80% of the shares of S Limited. So that makes P Limited the parent company and S Limited the subsidiary. And on the 1st of July 2021, the subsidiary sold a piece of land to the parent for an amount of 150,000, and this land had a cost and a carrying amount of 100,000. We are now required to prepare the pro forma journal entries to account for this land in the consolidated financial statements of the group for the 2021 year end. In order to prepare the pro forma journal entries, we first need to understand the journal entries that were processed by the individual companies, i.e. the parent and the subsidiary, and with that knowledge then we'll be able to prepare the pro forma journal entries, because remember, the pro forma journal entries are merely journal entries that are adjusting from what we currently have to what we want to see from a group perspective. So in the books of the subsidiary S Limited debited bank with 150,000 because that's the amount that they received for the sale of the land. They then credited land with 100,000 to de-recognize it, and they credited profit on sale of 50,000, being the difference between the selling price and the carrying amount of the land. In addition, because S Limited made a profit of 50,000, they need to account for the tax on that profit, and they had to debit income tax with 10,800 and credit SARS income tax payable with 10,800. Because this is a capital gain item, we apply the inclusion rate of 80% to arrive at that 10,800. But in the books of P Limited would have received the transfer of the land, and upon receiving such, they debited land of 150,000 to recognize this asset, and then they credited bank with the same amount to show that they paid this amount out of their account. So these are the journal entries that were processed in the individual financial statements of S Limited and P Limited. But these are only for explanatory purposes. You are not required to show these journal entries in the exam or in your assignment. You can have them as part of your working, so you can just have them at the back of your mind because they're not required. You only need to show the pro formas. So let's get into the pro formas. The first thing that we need to do is to eliminate the profit that was recognized on the sale of this land, because it's an unrealized profit because it relates to two companies in the same group. We eliminate that profit by debiting profit on sale of 50,000, and at the same time, the carrying amount of our land needs to be adjusted because it's currently sitting at 150,000 in the books of P Limited. But we know that from a group perspective, it should still be 100,000, as though this transaction never happened, because this is not a transaction with substance from a group perspective. So we credit the value of our land, or the carrying amount of our land, with 50,000 to revert it back to 100,000. We then eliminate the tax effect that relates to this profit on sale. So remember, we recognized income tax expense of 10,800 Rand in the books of S. We now have to eliminate that income tax expense because we've eliminated the profit that gave rise to it. And then we recognize a debit to deferred tax of 10,800 because this elimination of the income tax is a temporary difference that will reverse in the future when this land is eventually sold to external parties. In addition to these two journal entries, we need to look at the effect on non-controlling interest because it is the subsidiary that sold to the parent, so this was an upward sale, and therefore when we eliminate the profit on sale or the unrealized profit, the non-controlling interest will have to take a share of that elimination. And to calculate the effect on non-controlling interest, we take that profit of 50,000 less the tax effect of 10.8 and we multiply that by the NCI's percentage shareholding of 20%. That gives us an amount of 7,840 and we debit our NCI with that amount to reduce our NCIs because we've reduced the profits of the subsidiary, so the NCIs must also be reduced, and we credit our NCI P&L because this is a transaction that happened in the current year. The question is, what if you were required to prepare the pro forma journals for the 2022 financial year? And the answer is that you would simply replace your profit and loss account with retained earnings because at that point we would be dealing with a transaction that happened in the previous year, and we know that all profit and loss accounts are closed off to retain earnings at the end of the year. We're now going to look at an example of a depreciable TPE, and once again our group structure is the same, but in this instance we've got the parent selling a vehicle to the subsidiary and it was sold for a selling price of 150,000. The carrying amount of this vehicle was 100,000 on the date of sale. The remaining useful life was also given as 3 years on the date of sale, and once again we are required to prepare the pro forma journal entries. So like we did with the first example, we're first going to start by looking at the journal entries that were processed in the individual books of P Limited and S Limited, and then we will then use those to prepare our pro formas. In the books of P Limited debited bank with 150,000 to show that they received an amount for the sale of the vehicle. And then they credited the vehicle with 100,000 to de-recognize it out of their books. The difference of 50,000 represents a credit to profit on sale, and because it's a profit on sale, it will also attract income tax expense. So P Limited debited income tax expense with an amount of 13,500, which is just 27% of the profit, and they credited the SARS income tax payable account with the same amount to show that they need to pay this amount to SARS. It's a liability to SARS. In the books of S Limited debited vehicle with 150,000 because that's what they paid for the vehicle, so that is their cost for this vehicle. And then they credited bank with 150,000 being the amount that was paid to acquire this vehicle. Then from the date of sale, S Limited depreciated this vehicle, and they would have depreciated it based on its remaining useful life of 3 years for the last 6 months of 2021 because it was acquired in the middle of the year. So they debited depreciation with 25,000 and credited accumulated depreciation with the same amount. So with this in mind, we can then move on to prepare our pro forma journal entries. And once again, the first thing we do is to eliminate the profit on sale because it's an intragroup profit. So we debit profit on sale of 50,000 and we credit our vehicle account with 50,000 to revert it to what it should have been on the date of sale had this transaction not happened. We then eliminate the tax expense that was recognized for this profit on sale. So we credit our tax expense with 13,500, and then we debit deferred tax with 13,500 because this is a tax implication that will still be incurred in the future when this vehicle is ultimately used up or sold to external parties. Then the next thing that we need to do is to look at the depreciation adjustments. So we know that S Limited recognized depreciation of 25,000, but we need to look at how much the depreciation we should have had from a group perspective had this transaction not occurred. And had this transaction not occurred, we would have had to calculate depreciation based on the remaining useful life of 3 years and the carrying amount of 100,000, and that would have given us a depreciation expense of 16,667 for those 6 months. So we need to adjust our depreciation from 25,000 to 16,667. So that means we need to reduce our depreciation by 8,333. So we do that by crediting depreciation expense and debiting the accumulated depreciation account. Because we've reduced our depreciation expense, then effectively our profits are going to go up. So we need to account for the additional tax expense relating to this. So we debit our tax expense with 2,250 and we credit our deferred tax with 2,250 because this is once again a temporary difference that will be eliminated in the future. In summary, we've learned in this lesson that when you've got an intragroup sale of a non-depreciable asset, you need to eliminate the profit or loss on that particular sale against the PPE item, and you need to recognize the deferred tax to those adjustments, and you also need to consider the effect on NCIs, particularly if it's an upward sale. And when you've got a depreciable asset being sold between two companies of the same group, you do the same thing. You eliminate the profit against the PPE. You then adjust the depreciation since the date of sale to what it should be from a group perspective. And then you recognize the deferred tax for those adjustments. And you consider the effect on NCIs if it's an upward sale. If it's a downward sale, the NCIs won't be affected. This is the end of the lesson, and I hope you have learned a bit about these intragroup transactions, and I wish you well with your studies.